Netflix just raised their prices. So did Hulu. So did Apple TV. And because of that, the Fed's favorite inflation measure came in hotter than expected this week. That's right. Your streaming subscriptions may have just delayed your next mortgage rate drop. Let's talk about what really means for your clients. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Welcome to the weekend update. Let's get into this week's data. The big report this week was the December PCE. That's the Fed's preferred inflation gauge. It came in hotter than expected. Both the headline and core numbers hit 0.4% month over month, above the 0.3% forecast. Year over year, core PCE moved up to 3% from 2.8% the prior month. So what happened? Two things. First, shelter costs are still being measured in a way that doesn't reflect what's actually happening in the real world. Real-time rent data shows shelter inflation is close to 1% annually. But the government's calculation, which carries a significant weight in the formula, shows over 3%. That gap alone is artificially adding roughly 0.4% to the overall reading. Second, video streaming, Netflix, Hulu, Apple TV, Amazon Prime, they all raised their prices in December. Collectively, that single jump contributed about 0.1% to the monthly reading. Take that out, and we're looking at numbers that would have been right in line with expectations. Here's the key takeaways for your clients. This is a December report released in February, delayed because of the government shutdown. The next reads don't arrive until March 13th for January and April 9th for February. If those come in well, we could see core PCE move meaningfully closer to the Fed's 2% target. Q4 GDP came in at 1.4%, well below the 3% forecast. But again, context matters. The Bureau of Economic Analysis noted that roughly 1% of the decline was directly tied to how federal worker labor is counted during a government shutdown. Strip that out, along with trade adjustments and real final sales to domestic purchasers, a cleaner measure of underlying economic activity came in at 2.4%. That's a solid number. For all of 2025, GDP averaged approximately 2.25%. Not bad, not alarming. The headline number looked worse than the reality. Pending home sales came in softer than expected for January, down 0.8% month over month versus a forecast of up 2%. But the story here is the weather. The Northeast was down 6%. The South was down 5%. Heavy snow kept buyers indoors where skies were clearer. The Midwest and West numbers held up much better. The National Association of Realtors chief economist noted that with mortgage rates near 6%, approximately 5.5 million additional households would qualify for a home compared to last year. Even if just 10% of them move forward, that's roughly 550,000 new buyers entering the market. That's meaningful demand that hasn't fully shown up in the numbers yet. New home sales for November and December came in as two of the strongest monthly paces we've seen going back to early 2022. Builders are right-sizing production to match household formation rates. Both are sitting right around 1.4 million annually. If rates continue to improve, household formations can ramp up quickly. Builders can't keep pace that fast. That's a supply and demand setup worth explaining to your clients. On the mortgage application side, purchases are up 8% year over year. Refinances are up 130%. Refinances now make up 57% of all transactions. That number is likely to grow as rates continue their overall downward path. The 10-year Treasury is currently at 4.087 as we record this. Mortgage-backed securities have been bumping up against some resistance and could see a bit of movement in either direction in the short term. The 30-year fixed rate sits at 6.05%, with the 15-year at 5.62%. One notable event today, the Supreme Court struck down a broad set of global tariffs. The bond market had an initial negative reaction. Yields moved up briefly, but markets have largely absorbed the news and are trading near unchanged levels. This situation is still unfolding, and there will likely be appeals and alternative legal avenues pursued. So we'll be watching that closely. The longer-term trend for rates remains pointed in favorable direction. Strategy beats rate always, but it helps when rate is moving your way too. We want to make sure your clients are positioned before the opportunity window opens wider. This week, we're highlighting a few resources available to our partners. Are your VA eligible clients getting the full benefit of their loan? A lot of lenders don't fully understand VA financing, and that gap costs veterans real money. We also have one worth sharing with clients who think their credit reflects their payment habits. It often doesn't. Your clients may be doing everything right and still have a score that doesn't show it. And this one is worth a look for any client wondering what their property is really worth, not just what Zillow says. We've also put together a full suite of financial calculators, complimentary for our partners. This week, we're featuring the FIRE calculator. That stands for Financial Independence Retire Early. It helps you show clients what it would take to reach financial independence based on their current picture. If you want access to the full calculator suite, just ask. All of these resources, the featured tools and the calculator suite, are available on the right side of the dashboard on your desktop or below the video if you're watching on a mobile device. Next week brings a full plate of data. Monday kicks off with factory orders. Tuesday features Case-Shiller home price data, FHFA home price numbers, and the Conference Board consumer confidence reading. Wednesday gives us MBA mortgage application data along with January new home sales. Thursday brings jobless claims, and Friday, which may then be the most important day of the week, we get the producer price index, both headline and core. That will give us the first reading on wholesale inflation for January, and it matters for where rates go from here. Bottom line, the data this week had more noise than signal, but underneath the headlines, the housing market is building a foundation. Inflation is moving in the right direction, slowly, and rates are hovering near 3-year lows. That's a window worth paying attention to. We appreciate you viewing this. Have a great weekend, and we'll speak to you again next week.